some relief may be coming to your wallet after months of 40-year high inflation. There are signs it may have finally run out of steam. In Canada and the U.S., prices have moved in lockstep, climbing steeply, as you can see on that graph ahead of you, for more than a year. Finally, a dip south of the border, a small one, but it's there. Inflation there fell last month from 9 to 8.5%. The hope that the peak has been reached for both countries. Canadians are already seeing lower prices at the pump. The average price of gas in Canada was more than $2 a litre in June. That has since dropped 40 cents to $1.70 a litre. High inflation has been fueling talk of a recession. Is that still something Canadians should brace for? Jimmy Jean is the Vice President and Chief Economist at Desjardins. Sal Guattari is a Senior Economist and Director at BMO Capital Markets. Good to see you both. Thank you very much for making the time. Mr. Guattari, I'll start with you. Let me start on the question of inflation, because I think our audience is, of course, extremely anxious to find out whether the rise in prices has maybe stemmed off or started to plateau a bit. Do you expect Canadian numbers next week to follow suit with the U.S.?
Very much so. Yeah, the big story for the U.S. In July is that we basically saw no monthly inflation. Nice, refreshing change. A lot of that was on the back of a big drop in gasoline prices. We saw the same slide, 10% or so, here in Canada through July. So I would expect a pretty flat print for monthly inflation, and that will bring the yearly rate down from 8.1% to probably around 7.5%. So bit of a relief there, still very high inflation, but we'll see some relief, and hopefully we'll see some pullback in some of the travel related costs, because that was a big story in the US as well. So airfares, hotel costs, car rental rates came down quite sharply. It looks like Americans are starting to push back at the soaring costs in that area, and I would expect to see some of that downward pressure in Canada as well. So that's going to help a little bit as well. May not get much relief yet on the food front, even though crop prices have come down quite a bit. They still rose quite significantly in the U.S. and probably won't see much relief in the so-called core measures of inflation. So when you strip out a lot of the highly volatile items, they're still running around 5% here in Canada, and that's because of very tight rental and labor markets driving up rents and wages. So won't see much relief there, but at least headline inflation will pull back in July.
In layman's terms, Mr. Jean, if you're at the grocery store, if you're at the store, if you're buying, if you're renting a hotel room, does that mean, maybe you're not paying more than you were last month, but you might be starting to pay at least the same or a little bit less in the months ahead? Is that your interpretation of what might happen in this country too?
Well, right. We have to remember inflation is really the pace of increase in prices. So even if you're talking about slow inflation, that still means that prices are rising. So I think what we've seen in the U.S. yesterday is encouraging, but the big picture is simply that inflation might only be peaking at this juncture. And I agree with Sal, the next week's numbers in Canada should convey a similar signal. However, that's just one milestone, and it's still a very tentative one in what I think is going to remain a very long journey. And what's really important to understand in that journey is that this tightening cycle is as much about the psychology around inflation as it is about inflation itself. And on the psychology side of things, I think it's way too early to think that we have seen anything conclusive that suggests inflation expectations are going the other way.
Mr. Guattari, let me ask you about the other side of what Canadians are dealing with, not just high prices, but higher interest rates. What do you think might temper those hikes in the future? Like, what kind of trends would you have to see where inflation is concerned to expect a less aggressive posture from the Bank of Canada?
Well, I think if the Bank of Canada sees lower inflation in July, and if that's followed up with other signs that price pressures are moderating a bit, along with ongoing weakness in the economy. Remember, we've seen back-to-back job declines now in Canada. That would probably be enough for the Bank of Canada to pull back on the pace of rate increases. So instead of another 100 basis point rate hike, we'll probably see something about half that in September. So the Bank of Canada will be able to tone down the pace of rate hikes. But that said, I agree with Jimmy that, the bank cannot stop at 2.5%. They're probably going to raise rates further. We believe ultimately another percentage point by the end of this year, simply because of that underlying inflation pressure in Canada. And inflation rates, even though they're coming down, are going to take a long time to get back to that 2% target. The bank could still be facing or staring at a 3 handle on inflation rate by the end of next year, so well above their 2% target. So any possibility of rate cuts, I think, are more a 2024 story.
That long journey that you referred to, and Mr. Jean referred to, sorry, and then sort of how high inflation will not be something that's wrapped up, let's say, by the end of the year. What does that do to your assessment, Mr. Jean, of the potential for a recession a year and a half out from now?
Well, certainly this is the biggest thing that's on top of everybody's minds right now. Why? That's because, you're looking at central banks that have started the year with a deficit of credibility. Now they're trying to restore that credibility, but that warrants forceful actions. And even though we've seen some early signs of maybe peaking in inflation expectation, they still have to restore that credibility with some more intervention. So yeah, we do expect to see more both in the U.S. and Canada. But that also comes with the cost of potentially slowing and even pushing the economy in recession. But that's really what might be necessary. We have to kind of accept that really the problem is not inflation. The problem is just demand that has been running so far ahead of supply. And it's, historically speaking, it's been very difficult to be able to bring down inflation unless you have a contraction in aggregate demand. Now, there are some factors that suggest that there's a lot of potential resilience, especially in the labor market. We're at a very different place than we were in previous cycles. But I think that soft landing hope that everybody has is still a very delicate and difficult exercise.
Mr. Gualtieri, I just have about 30 seconds left. If you were to assess the chances of a recession in about 18 months, what would you tell our audience tonight?
Yeah, unfortunately, we think the chances of recession are about even now. So it's going to be pretty close. We still see the economy, for the most part, expanding over the next year, but it's going to be a pretty close call. We see it basically stalling by the end of this year. Could see one quarter of contraction early next year before resuming growth. The important thing is that should support the economy is that we don't expect policy rates to rise too much further. They'll probably rise to moderately restrictive levels, not enough to push the economy into deep recession. And many households still have a lot of excess savings that I think will support spending. But again, it's going to be a pretty close call as to whether we tip into at least a mild recession.
Okay, you've given us lots to think about. Thank you very much, both of you, Jimmy Jean and Sal Gualtieri. Hi, I'm Vashi Capellos, host of Power in Politics. See more of our show by subscribing to the CBC News channel or click the link for another video.